Well, the cuts keep coming in Canada's hard-hit energy sector. Our top-line story at this hour is that of Suncor. Suncor slashing its dividend by more than half. It is scaling back its spending plans. This all part of a goal of shielding its balance sheet from those weak oil prices and, of course, the continued fallout tied to COVID-19. All told, it was a massive quarterly loss. For some more on the outlook for the industry and some reaction to the Suncor quarter, we're joined by Rafi Tahmazian, Senior Portfolio Manager at Canoe. Rafi, I'll start with your overall reaction to what Suncor has told us.
I think it's the dividend cut in particular is something I just didn't want to see yet. I think that the market was possibly expecting it because of the Shell cut earlier, a week earlier. And, I think you're dealing with two different animals there completely. I think you're dealing with, a super major in Shell having to make fundamental decisions right now about the company and what they are versus a pure play like Suncor, where there's also an enormous business, obviously, but not of the super major caliber. And I think I would have liked to have seen them wait out and try to understand how this demand and supply globally is going to play out for prices before they made this decision. I think, John, it's also very important, though, people understand that in this day and age right now, these are big companies that are making very big decisions right now. And so it's so much more than just me saying, why did they cut? There's a lot of debate probably that went into why this happened at a board level and a management level. And, I would have, if they're going to make this cut, then I would have liked to have seen an even more robust explanation as to why. With 10 billion of excess liquidity that they claim to have now, almost 9.5 billion. I just didn't see the need to do that quite yet.
And is there significance for the rest of the Canadian sector if Suncor ultimately does what it does? Like, what kind of message does it send to the rest of the producers, Rafi?
Well, the first thing these producers have to do is they got to get their house in order and they have to ensure that they have good liquidity. That's one of the first messages, and Suncor did that, and good on them. The second thing Suncor did is and that's something you can commend them for making the cut, along with a lot of other cuts they made within the business, is which includes reducing production. Is that they drove their costs down. And what you want to be once you figure out that you've got your liquidity is you want to be the lowest cost producer of whatever liquids you're producing. And so, they are trying to become the first one to be profitable when oil prices start to recover, because they'll be rewarded for that. And that's the message everybody should be getting. Get your costs down fast. First, get your liquidity, then get your costs down. And then look at your dividend.
That does feed into the story of trying to figure out the road ahead. And we were talking with Andy Bell earlier about how, at the end of the day, Suncor's being cautious about where oil prices go, but they also talked about seeing consumer demand recovering in the second half this year. What's your best sense on the road ahead for oil prices?
Yeah, so we would agree with that. We're very encouraged by the collapse in the supply side across the board, including the OPEC nations. We don't think they're just cutting production. They think they're shutting. We think they're shutting in because it's unaffordable for them as well. The destruction of the supply side is important, per your speaker you had on a little earlier. But I think what's the most important issue is the demand. We can cut our supply all we want, but we need to get that demand starting to turn around, and that's only going to happen if we're getting back to work. So you're seeing this recovery right now in the short term as governors and premiers in the North America start talking about getting back to work, and that's allowing the futures to get excited about the oil price, and that's why you're seeing it rally in the short term here. But ultimately, supply is going to be answerable to demand, and we have to see how dramatic this cutback in supply is, and when that crossover in demand is. And we We think it's very healthy for Canadian oil and gas because really the culprit on the supply side, we think, is the shale oil. About 10 million barrels of oil that was brought in to alleviate, to offset a lot of the shut-in cutbacks that OPEC was doing prior to this.
Before we let you go, Rafi, speaking of dramatic, I mean, to cut the dividend roughly 55% there and to continue to cut their capital spending upwards of $400 million, I mean, these are big moves that we've seen. I do wonder, though, is this the last of it? What would you say to
that? Yeah, I mean, there's $9.5 billion of liquidity that they have. So they have about $3.5 billion, I think, of fixed costs. Call it roughly. These are big numbers we're throwing around here. And their break even is $35. That's a pretty good price for me to stomach for a company like Suncor. $35 is not an unreasonable expectation, I think, over the next 12 months to expect the oil price to be recovering to. In fact, I would be hoping that it might be a little higher than that by that point. So you could see a company like this in the black more likely than having to think about further cutbacks in their dividend in the future. Again, I can't emphasize enough the importance of getting demand back, but at these prices, roughly below $35, you've got massive shut-ins happening across the board. And we're going to start to see the impact of that imminently and probably will be very favorable for the group as a whole.
Yeah, and got that jobs report on Friday. Rafi, thanks a lot. Really good to get your context. As always, Rafi Tahmazian of Canoe Financial joining us with his take on the energy sector and on